I'm Clara Hermit and this is Mould on Markets, our regular look at the financial markets with Investment Director Russ Mould. Russ, how are you?
Very well, Clara. How are you? It's good to see you.
It's good to see you too. I'm not too bad at all, but what we need to know is what is it that advisors and their clients should be thinking about?
Well, there's no shortage of options right now with Puerto Rico, with Greece, with China, for example, but we do in the end really have to talk about Greece again, I'm afraid to say, after the referendum result, which saw the Greek voters reject European proposals for a third bailout with quite a few austerity strings attached by 61% to 39%. Now, events are moving incredibly quickly, but for the moment at least, ahead of any fresh EU summits, Greek Prime Minister Tsipras is arguing the vote actually strengthens its hand when it comes to negotiating a deal. Berlin and Brussels, much less convinced, saying there will be no more talks until Athens offers more concrete plans for long-term fiscal and economic reform. So in sum, the referendum's really not changed desperately much, but it does, on the face of it, increase the chances of Greece leaving or being ejected from the Eurozone and the Euro. Note here that there are rules for a country leaving the EU, but there's no mechanism for exiting the single currency, so any departure could be messy. For example, if Greece leaves the Euro but stays in the Eurozone, the rules mean it eventually has to reapply to join the single currency. Only the UK and Denmark have got an opt-out for now. But anyway, a Greek exit, it's nothing that anybody really wants to see so far as we can tell.
So far, so complicated. What needs to happen from here?
Okay, so two things. I know the European Union doesn't want to go down that path, but there has to be some debt relief. The International Monetary Fund is even saying it now, while for its part, Greece has to show it's trying to get its finances in order. So on debt relief, Greece has too much debt. 323 billion euros is 180% of GDP. Now that can't be sustained, and the European solution of throwing more debt at it, no matter how cheap, simply isn't working. Creditors have to therefore take a haircut. And even if they don't offer longer maturities at even lower rates, or debt forgiveness after orderly talks, they'll probably get a haircut through a disorderly default and devaluation of any new Greek currency, should a Greek exit not be avoided. Now as such, they're probably better off going down the orderly route to protect themselves and also give Greece a chance. Unemployment of 25%, youth unemployment of more than 50% shouldn't be acceptable or tolerable, especially as the EU's ultimate goal is prosperity. Now, for their part, the Greeks do have to do something. There's no free lunch here. They need to offer long-term changes to labour laws, inept public administration, tax collection, corruption, to show they're serious about change. Now, even if they give up or are forced to give up on the euro and use a new drachma, they're going to need money from somewhere, funding, internal or external, tax or credit. Remember, the old drachma went from 30 to 400 against the dollar in the last 30 years of its existence. So Greece's record isn't one that would encourage new lenders to queue up necessarily.
So while we wait to find out if there's going to be a renegotiation, or whether Greece is going to stay in the Eurozone or going to stay with the Euro, what are the markets going to be doing?
Well, there's multiple possible options, but there's probably three major ones. Brussels and Athens actually strike a deal, which, is probably in the end what everybody really wants deep down. Second, the European Central Bank steps in, tries to maintain calm by accelerating or increasing its quantitative easing scheme. Or third, the worst option, talks fail, chaos breaks out. Markets fear a rerun of 2010 and 2012, when Greek woes had a big and negative impact on European economic and broader market confidence. Now, investors might even start to worry about Italy, Portugal and Spain again, especially if Greece does exit, or maybe even if it's offered massive debt relief. Now, for the moment, the market seems to think there will be a deal and a disorderly Greek plunge out of the euro can be averted. After all, 1. The euro's lost relatively little ground against the pound or dollar at around the 70p and $1.10 marks respectively, even though as the first chart here shows, euro pound on one side and euro dollar on the other, the general trend in the single currency this year has been down. Second, if a euro fracture was likely, you'd expect currencies with independent central banks, Swiss franc, Swedish, Danish krona, maybe even Sing dollar, to do well, and maybe sterling in the greenback. But there's been no massive movement there either, nor has gold moved in dollar terms, or even particularly in euro terms. There's not been a big dash for havens yet. Finally, stock markets haven't been brilliant in June, but they've not collapsed. The Euro Stock 600 is actually still up for the year, even if it lost some games ahead of the Greek default and the IMF and the referendum vote. It's still in positive territory in euro and sterling terms, even if again single currency weakness is eaten into returns on the latter.
So if the markets did smell a Greek exit, then these asset classes might give us a clue as to what's coming around the corner?
Definitely possible useful indicators. There's also some very good research from French investment bank Exane BNP Paribas, which shows how the Euro stocks fared during 4 previous Greek crises between 2010 and 2014. And the average index loss was around 15%. So it would be unwise for us, any of us, to be too complacent, even if there's anecdotal evidence that some fund managers have built up cash so they can take advantage of any market dips. So let's see if they get the chance, and if so, whether they keep their nerve.
Okay, thank you, Russ.
Thank you.
Thank you to you for joining us. We'll see you next time. Goodbye.